Um, so we've got somebody asking that about the impact if they sell their business before or after the end of the tax year. And we've got another question which is not dissimilar. So I'm just going to find that one and add those together, because I think, in fact, there's a few questions all around this selling the business. Somebody else is saying that they're selling the business and they should complete before the end of the tax year, but they've got a 2-year earn-out. So how's the capital gains going to be calculated on that?
Right.
We've got another couple, but I'll leave you those two for the moment.
Yeah, no worries. So I think the big changes from a capital gains tax point of view that were announced were the increase in the main rates from 10 and 20 to 18 and 24, and they were effective immediately. So they were, any sale that took place on budget day and afterwards is going to pay the higher rate. So a business sale on that date would effectively have the higher rate. And so in a sense, almost the end of the tax year doesn't impact on that change.
Okay.
The key change that it does impact on is, beg your pardon, business asset disposal relief, which again, everybody, including me, still refers to it as entrepreneurs relief.
Yeah.
But essentially, that's the rule that says if you sell a trading business and you meet the qualifying criteria, then at the moment, if you sell that business, then the first £1 million of any gain that you make up to then, that's a lifetime limit. So if you've had multiple disposals, you only get 1 million hit. That would be taxed at 10%. And then any excess would be taxed at effectively 24% now, as opposed to 20% before the budget. For disposals that happen after 6th of April, then that entrepreneurs relief rate goes up to 14%. And then from 6th of April 2026, that goes up to 18%.
Yeah.
So you can see, in much the same way as people were rushing to try and get stuff done before the budget, people are now going to be potentially thinking, well, if I'm going to get a sale done, I want to get it away before the 6th of April, because otherwise I'm going to pay up to an extra 40 grand of capital gains tax on the disposal. I think the important point to be aware of here is that although we talk about the sale completing, it's actually when the contract becomes unconditional is the point that the disposal happens from a capital gains tax point of view. So if the contract becomes unconditional but it doesn't complete, i.e. effectively the money doesn't change hands for a period after that, then it's the date that the contracts sort of are exchanged, almost become unconditional.
So like not to a property purchase, exchange and completion.
Exactly, yeah. So it's pretty much generally exchange rather than completion that sets the date that the disposal takes place. But actually the tax rate's fixed by when it completes. So it's a slightly random.
Okay. So if you exchanged on the 30th of March, and completed on the 15th of April.
Yeah, I think I've probably explained that slightly badly. So exchange sets the date of disposal, that sets the rate, but when you actually pay the tax, is what I meant to say, is by reference to completion.
In that instance, the tax rate would be set at the 30th of March date.
Correct.
So it wouldn't have changed for the as per 6th of April. However, the tax year in which you'd pay it would be the year.
Correct.
So that gives you a longer period of time to pay that.
Correct.
A much longer period of time.
Yeah, and I mean that's a reasonable thing to do, because obviously you don't get the money till you complete. So, but also I think, and just before people get too excited about it, HMRC will absolutely, there are rules in place that basically say, well, if you're trying to concoct something where you're saying, well, we've exchanged here, so the contract is unconditional, but it only completes
if you push it on purpose.
If you try and play silly games with it, then there was they've introduced what they call anti-forestalling rules, which effectively look at people artificially kind of trying to create a tax point before the rate changes, but actually only end up having to pay after the rate changes. So if it's a genuine commercial transaction and for whatever reason it can't complete, or for a couple of months, but then if it can't complete, is it actually conditional anyway? So but fundamentally 6th of April is kind of or 5th of April is your target date. If you can exchange and complete, simplifies everything massively, and you get the 10% the 10% rate.
Okay. And then for the question of if you've got a longer earn out period, I mean, my understanding is that it's kind of tough. You pay the tax based on the money that you're going to get.
Correct. Yeah.
And then I suppose if you don't get all the money that you've been promised in the earnout, you have to claim some back further down the line, or
yeah. I mean, and I think that's a good summary. But I think, and this is, I mean, we could go down a massive rabbit hole here, but effectively, there's a distinction between what we call deferred consideration and what we call an earnout. So deferred consideration is a fixed amount. You're just not going to receive it for 12 months. You're absolutely right on that one. You effectively treat it as if you receive the cash on the day that the sale completes. So you pay the tax based on that, even though it might be 12 months or even 2 years before you actually get the cash. Earnout's a slightly different thing in the sense that an earnout, a true earnout, is kind of predicated on something that hasn't happened yet. So it might be you only get your cash if the business, does X, or in terms of revenue. So there, I won't bore you with the rules, but essentially the way the rules work is you kind of almost have to estimate how much you think you're going to receive, and you pay tax on that as if you'd received it on day one. But then you have to adjust that depending on how much actual cash you receive down the line. And so on the earnout, the amount that you estimate, you pay tax at the rate that's in force when you make the disposal. If you receive more than what you estimate, then you pay tax at the rate that's in force when you get it, as opposed to when you sold it. So.
And are HMRC mean enough to charge you interest if you pay less?
No, because I think as long as you've made a reasonable attempt,
as long as they sign
off. If you've kind of said, if you know that you're pretty much going to get, £1 million, and you say, I'm going to stick 100,000 in, then you might not get interest. But what you might get is a question from HMRC, sort of, well, how did you actually arrive at this number, and why is there such a big differential between what you estimated? So it's not, again, it's something that you've got to make a reasonable attempt at. But as long as you do, then effectively HMRC might challenge you on how much you've included, but they won't say, you should have, you'll pay interest on kind of any tax that you would have paid had you been exactly. You don't have to be exactly right. Nobody obviously can be exactly right, but you've got to have made a reason.
Okay, so it's not like payments in account.
No.
Very quickly then, last one on this, because I'm sure we talked about it pre-budget, that you can actually come into some sort of agreement where you will only pay the tax when you get the cash, almost like cash accounting rather than accrual accounting.
Yeah, there's an instalment rate. Effectively, if you're not going to get all of the cash up front, there is a mechanism that allows you to kind of almost agree an instalment plan with HMRC. I think the issue is that what they look at is, well, have you received enough cash to pay the tax by the time the normal due date is there? So I think I've only ever seen one situation where enough has been deferred that actually HMRC were prepared to enter into an arrangement, because they're saying, well, you've had enough cash to pay the tax by the time it's due, so
pay the tax and hold off on the yacht. Yeah. Okay, fair enough.